Over the course of the past 18 months, the inflation rate has continued to rise steadily. The exchange rate has been devalued about 3 times, and the economy even slipped into recession. This week, economic backdrop affected the performance of asset classes to varying degrees. The climate is now filled with uncertainties, leaving investors with many questions than answers. Hello, and you're welcome to Meripod. I am your host, Ahmed Jinad, and today I have with me Adeni Adebisi to provide some of the answers that you seek as an investor. Adeni is an experienced wealth advisor at Meristem Wealth Management Limited. Welcome, Adeni.
Ahmed, thank you for having me.
All right, so this should be a very interesting one. I mean, in previous episode we've been all technical and all of that. So as a wealth advisor, I mean that has helped several clients to navigate through this tricky period. What are some of the most important questions that you've had from clients in your discussions with clients?
So I think that the pandemic was good, and bad at the same time. But I feel, it was more good than bad in my own perspective. And saying that is because, you got a lot of people thinking. You got a lot of clients, looking at their investment as a whole rather than as a unit, which means that the question around consolidation of their portfolios and also documentation and, keeping proper records of what they have. And those are what are key things that happened in the pandemic. And also, people, now understood more in detail how these events can affect you as an individual and also your investment. Yeah, so a lot of questions about foreign currency, a lot of questions about returns and how soon or how soon would leave recession, for example, or how early are we going to have the exchange rate back to normal. Yeah, those are questions that that were repeated over and over again during the period.
And if I can add, did you get a huge shock in terms of a lot of investors maybe not even having an idea of what their portfolio looks like? And I'm saying, apart from saying maybe looking at their equity portfolios, knowing that okay, I have this, but in terms of the universe of assets that they have, did it take you by surprise how a lot of investors don't even have that idea? And I'm saying that because during the pandemic, asset class performances were very divergent, and so it took a lot of you had to do a lot of portfolio review allocation in terms of okay, where do I weight my investments more, which ones do I weight less. So I mean, and then when you were responding to the earlier question, did you get a huge shock from people not even knowing what their portfolio looks like?
Okay, sincerely, I'm not surprised. Over the years this has been the trend. But the good thing is that I think lockdown really helped. So, maybe it was boredom, maybe it was, having nothing to do, but then people just had enough time on their hand to sit back and then look around out of boredom, to check their document, their files, and then be reconciling. Because some clients have investment generally, but points that they have things they've done in their very early years, in their 20s and 30s that they probably don't know, where it is. They have no idea how the company is performing. Maybe most of the times, maybe somebody bought a land during some sort of event in the past and can't even find documents, don't know where the receipt is, has not even entitled up paperwork. So yes, during that period, all of that came up. And just showed you that people are just probably too busy, to look through these things. Even for clients who are portfolio management clients, those are clients that you serve, on a discretionary basis, they still probably don't look at the reports every month. So but during this period, yes, they had enough time to review it, to ask questions, and then as an advisor, it felt really good because you're also able to explain your actions to the client and the results you're able to achieve over time.
So going forward now, what would be the advice? Like, how can they make sure that they track what they are doing with their funds while not getting lost in the other things that they are involved with?
So, as the case is, planning is
There's
very,
a
very
structured approach to go about it.
Okay, so yes, of course there is a structured approach to go about it. But the point is, so it depends. So there are two sides to it. There are some investors that want to do DIY, do themselves. And the investors who have transferred that responsibility to, an investment manager to manage on their behalf. For those who want to do themselves, planning is very, very important. And documentation is also very, very important because, you are here today, no one is guaranteed tomorrow. And important that you protect your loved ones by documenting properly, what you have in investment, and also in documenting, also completing your what's it called, your
IPS.
Yeah, not even IPS. I talk about your third-party information
Okay.
when it comes to any negative, any eventuality as the case is.
Yeah.
So those things are very important that we document them. It's not when you say fill a form and fill all these details into it. It's not because somebody just wants to get your data and use it, for I don't know, maybe it's not for fraud or something. But the point is that every information that is captured, from you is very important now, later, and tomorrow. But planning is very, very important. Working with with a professional.
All right.
Very critical.
Like that's very
Because
important.
it's not enough to read the newspaper in the morning.
Yeah.
It's not enough to blog in the afternoon. These things, time is very, very important in investing. An opportunity that can be available, in the morning, and by lunch is no longer available.
Yeah.
And some people, if you follow so I don't drop, but the point is that the markets that are very volatile that
Yeah.
you could lose, for example, the way, during the lockdown, in the oil futures went, negative.
Yeah.
So if you had a position, during that period, and you were not a trader that understand, the losses, stop loss, and all those details, you probably lose all your wealth.
Yeah.
Before you open your eyes. And so so you need to work with somebody, you need to plan, and you need to document.
Oh, great. Thank you so much. So I think that sets us up nicely for what's my next question. And it has to be. I think this is where a lot of listeners will actually find interesting, and that is how should they approach these uncertain times in terms of investing and financial planning. And let me give a little bit of more color to that question. During the most of last year, we had equities performing brilliantly, while fixed income yields were dropping to ridiculously low levels, and a lot of people rotated out of fixed income instruments.
Yeah.
But now we are seeing a reversal. Now, for a lot of people still have interest in equities, but they are saying, are the prices too high? Yields are picking up in the fixed income market, and some people are saying, is it good to go in now, or should I just wait until yields are significantly higher than current levels? Even in real estate, I was discussing with a couple of my colleagues over the weekend, and the kind of rates they were telling me for rent now, especially in all these commercial areas. So it brings up that question that for investors who are sitting on funds and they are trying to invest now, what should be the approach? Is there any advice about what to do to maximize the return on investments?
Okay, thank you very much, Ahmed, for raising this. So, key to investing is that when you're investing, there has to be a foundation to it.
All right.
And first thing is even knowing, your risk appetite. That's your risk tolerance, the level of risk you can take, and the shock you can absorb at every point in time. When you know that forms the foundation for your investing activity. And asset allocation is also very important. What you allocate to equities, what you allocate to real estate, what you allocate to fixed income. Are you able to absorb, the volatility of equities and the loss that may come with it? Are you the type of person that just wants safe investment, go to bed and sleep, and not be worried about anything? Are you the long-term investor that are looking to, capture capital gain on your real estate investment? These things are very important because when you know your risk appetite, you can determine that. Then it gives you a foundation to be able to allocate your assets. And very important thing that happened, when you're into lockdown is having a diversified portfolio. Feel like it's diversified enough, to be able to balance during this type of shock. If you are, for example, during the lockdown, if you're 100% weighted, towards fixed income, your income, and you're retired, your income will probably be almost zero because treasury bill yields went down to about 1%. Imagine you're in retirement and all your funds are in treasury bills, and you have to earn 1% through a very difficult period, which means that you probably not even earn anything during that period. Secondly, is that if you have a diversified portfolio, there's a great chance that you have some element of your portfolio in real estate, for example. You have some in fixed income, and then maybe some in equities also. During the lockdown, as a case study, equity market rallied up positively to a great extent. Fixed income market was down to a great extent, but property value kind of appreciated. Yeah. Even though it was struggle to pay rent was difficult because a lot of people were out of job. But the point is that the portfolio is balanced across those assets, in a very way. There's a good chance that you survive and have some income. Maybe not what you expect, but at least there'll be some sort of balance where you're able to weather the storm through that period. So yes, you've got to look at your portfolio as a whole. Pay attention to asset allocation, diversify your portfolio enough so that you can withstand shocks like this. But as I say again, just always speak to professionals about these things. It's okay to know it by yourself, but just get a second opinion, so that so let me top it up. During that point, Nigeria's currency lost a lot of value, and we're not even sure direction of naira against the dollar. And people started seeking protection in dollars, and the price went up and up. But if you had a portfolio that had all of that in view, you could have adjusted very early. So imagine that you had captured dollar when it was at 30, 360 or thereabout. So you can get a capital gain. You can also get a return on investment. And dollar returns during that period was even higher compared to any naira investment. So plan is very important. Talking to people who know or who are every day involved in the market is very good, because that way you can share your ideas and then be able to use that information to take decisions that would improve the return on your investment.
Great. So lastly, it's good that you talked about diversification. So again, we are seeing an increase in appetite for foreign assets, foreign equities. People want to invest in the US stock market, and then we are seeing significant interest also in cryptocurrencies and other digital products. For you, first thing is, let me get your take on that. Do you think it's a welcome development, or it's just the inevitable conclusion to the continual depreciation in the currency? And in the light of the recent the recent ban by the authorities, how do you see this shaping up over the next few years?
Sincerely, I think that these things are not going to go away. I'm sure when when traders started trading derivatives, this must be, I probably wasn't privileged to that period, but I'm pointing that this kind of sentiment you get and feel as you get from the market as a whole, and appetite in the Nigerian market right now, you can understand.
Yeah.
First, it's a generation thing, because they want to explore. They are very risk level is pretty high. They are very open, and they're vast also. Well read. Obviously, the world is open. You can learn anything. You can read anything. So yes, and for the difference between what makes these things interesting, in my opinion, is that the information is already available for people to access.
Yeah.
If you want to buy crypto today, if you from 0 to 100, the information is available somewhere online that you can study and you can start trading. If you want to buy, US equities or UK equities or Asian equities today, that information is available, and there are platforms that are available for you to do that.
Yeah.
And those institutions, and I think if we look at market, what you find is that we don't speak about these things enough. Not everybody knows that you can trade Nigerian equities online real time.
Yeah.
But the more you push the information out, the more people know, the more they can then engage. So I feel these things are here for stay. Cryptos, trading, forex. Yes, some people, but knowledge is very important in everything.
Yeah. Because
it is available, because someone says you can buy penny stock in America and make 100%. So yes, you can also make 100% loss.
Yeah.
During the whole drama of retail investors and institutional investors drama, why some people made a lot of gain, some people carried a lot of loss. Like stories of people who put up a lot of their money, people even withdraw from their pension fund and took our insurance and put it in there, and before they knew it, market is already. And because knowledge is very important.
Yeah.
What's the right entry? We talked earlier. You were asking about when it's good to go in and when to go out. One of the things we advise is that you stagger these things. If you plan to buy $1 million, or if you plan to invest $1 million, if you want to invest in risky assets, just do it over time. That's cost averaging effect, where over time even though the price goes up and down, on the average you can be balanced such a way that you can take advantage of up and down side. But when you just come in at once, and you invest all that you have, and the market goes down, for example, you're unable to make an adjustment, except you have more funds to keep averaging down, and who knows what the end is. But if you have $1 million and you just keep doing 100 and 100 and 100 and 100 over time, that way you're able to balance out over time, and you're also able to keep your costs at a very reasonable average level, such a way that when market goes down, you can absorb the shock. When there's upside, you can also catch up the gain.
In such a short time, I think we've unpacked a whole lot. Thank you so much, Adini, for coming on the show today.
Thank you very much for having me.
I'm sure I'll bring you sometimes in the future as well.
I'll be very happy.
So that's our show. That's our show today, guys. Thank you for tuning in and listening. You can also listen to the previous episodes on the platform. We would like to hear from you. Send us emails on research@meristemng.com, and we would like to take those feedback and so that we can respond. And if you have questions or other inquiries to make, you can send us an email to the same web address. So that's our show today. See you next time. Bye. The views expressed in this podcast are not necessarily those of Meristem. Meristem is not providing any financial, economic, or legal, accounting, or tax advice or recommendations in this podcast. This information does not constitute investment advice and should not be used as the basis of any investment decision, nor should it be treated as a recommendation for any investment. All price references and market forecasts mentioned in this podcast correspond to the date of this recording, and reference to specific securities may not be construed as a recommendation to buy or sell these securities and have been mentioned for the purposes of illustration only. Investors should also note that the views expressed may no longer be current and may have already been acted upon. If you need more information about the suitability of investments, you are advised to speak to an authorized financial advisor. No statements made in this podcast are legally binding on Meristem or the recipients of this podcast. This podcast should not be copied, distributed, published, or reproduced in whole or in part.